Hey everyone, how are you doing? Welcome back to Lunch of the Market. Hope you're having a terrific day. Until further notice, we expect all rallies to be sold. There's just no impetus for the stock market to go higher until one of three things happens. Either A, our government decides that we need energy infrastructure and they put millions of people to work on getting oil from places like Cushing, Oklahoma to where we actually need it in the Gulf of Mexico in the Northeast where the refineries are. Okay, that would be a huge boon. Natural gas infrastructure in which we ran our transportation sector or our power sector off more natural gas would also be super bullish. The other thing would be if we see a resolve of the crisis in Europe. I mean, Europe is just really an ugly place, and I mean, Germany looks to be slowing. France didn't come in as nicely as we wanted to on PMI. There's just really not a lot of growth right now. We are definitely in a soft patch. And so the question, of course, is this a soft patch or is this the start of another leg down? So far, we are in the camp of this is just a soft patch. It's seasonal weakness. We see this every summer, and we're going to see a pickup in both economic activity, and we should see continued strong corporate earnings in July, and that would set us up really nicely for the rest of the year. So ideally what would happen is we trade down to that level that Carter Worth identified yesterday on Fast Money, which is around 1184, which is the 150-day moving average for the S&P 500 index. If we do, then what Carter Worth is saying is that we set ourselves up for a more dramatic snapback rally if that happens. So I like the market to continue to trend down until we see that level. Okay, 1300 could be the level that we bounced. The other level is 1284. If we do that, especially if we bounce there, I think that's going to be seen as very healthy by a lot of people, and I think you're going to see us run into the end of the year, again, pending good corporate earnings. The only thing that could really just totally crush the bulls case, and it's because the only leg that they're standing on right now is good corporate earnings. The last quarter earnings were great. We traded up. We touched that 1360 level, and then we sold off ever since. In this vacuum, this void of news that we get between now and when July earnings come in, that's when we see the market tend to trade to the downside. So we're going to continue to believe that rallies, pop should be sold until we get closer to July. In fact, I want to see all the way through June. And we really have very, very, very few June positions on in terms of options. Most of our bets are July, August, September, October. Okay, we're basically not excited about the summer, but we believe that in the weakness that we're seeing, like we did yesterday, we're going to buy those in the money call spreads and then sell those out of the money put spreads, and in some cases in the money put spreads, but way out on the calendar, right? Again, July, August, September, and October. We get a ton of time value for selling those right now, and again, if we see the lows during the summer, which seasonally we have for many, many years, go pull a 20-year chart of the S&P 500 index and take a look at what happens every summer. I mean, it's called sell in May and go away for a reason. All right, so what we did today, look, financials. We have not talked financials at Magnum Opus Financial for a long time, and with good reason. They've been grim death for a very long time, certainly since May, but even before that. So we took a look at Citigroup, Wells Fargo, JP Morgan Chase, Bank of America, BB&T, and Zions Bancorp. Okay, we did all 6 of those companies, and we took a look at market cap, the float, which is the amount of outstanding shares that are available to trade on the secondary market. We took a look at the cash on the balance sheet. We took a look at debt on the balance sheet. We took a look at return on assets and ROA and return on equity ROE. So you wrap all that together, what do you get? Okay, here we go. JP Morgan sits at 3.9 billion shares for their float, Citigroup at 2.9 billion shares, and Wells Fargo at 4.94 billion in terms of their float. Okay, all of the big banks have less than 1% of their float sold short, except for Citigroup, which is actually around 13% of the float is sold short right now. Of the 4 big money center banks, they all have a market cap between 116 and 169 billion dollars. Both ROE and ROA for Bank of America are negative, compared with an ROA of around 1% for banks like JP Morgan and Wells Fargo. Citigroup is actually only 0.5 of 1% in terms of their ROA. ROE for JP Morgan and Wells Fargo comes in at 11%. Again, Citigroup comes in at 5.95%. Again, both ROA and ROE for Bank of America are negative. Okay, so Citigroup trades close to $40 a share, and the only other bank that trades in the $40 range is JP Morgan Chase, which is arguably an extremely strong bank. In fact, it's a much stronger bank than you get out of any of the other banks in the banking system. JP Morgan is best in class, and I have to say that I don't think Citigroup is best in class. It may have a decent franchise, but I don't think it's more decent than, say, BB&T and Wells Fargo, both of which trade in the high 20s. So, what's the trade? Well, I think you can get long Bank of America and short Citigroup. So it's kind of it's a pairs trade, right? You've got a stock that seems to be way, way overvalued in the high 30s, almost the 40s, and then a bank that seems to be way undervalued in the low teens. So, we like the Bank of America January 2013 12.5 strike calls. You should be able to get them for around $1.42. Okay, that's extremely cheap, and you're buying completely time value. But you have over a year and a half to be right. Okay, so why so far out on the curve? Well, because we hate banks here, and you need time to be right. And the reality is, when this bank gets up to $15, let's say it does it by Q1 of next year, you're going to have all the time value, say around 80 cents, plus the intrinsic value of $2.50. So you should be good for around $3.50, $3.70, okay, in terms of maybe $3.50 for what you'll get. If you pay $1.42 and it becomes worth $3.50, I'm pretty sure you did just fine on the trade. Okay, even if it takes a year for this thing to materialize. Second, if you take a look at the other side of the trade, which is the short Citigroup, take a look at the August 35 strike put for 67 cents or the September 35 strike put for 87 cents. Both sides of the trade, the long January 2013 Bank of America and the short either July or August Citigroup, we think could go to 100%. Obviously, the Citigroup's going to happen sooner rather than later. We got two things. One, Citigroup really seems to be overvalued. And I'm sorry, if you take a look at what AIG did after its reverse split, it has done nothing but trade down. And if you look at a chart of Citigroup, it's pretty much the same thing. So we expect that bank to trade down until it gets in line with the share price. I don't care that they just did a reverse split. The bottom line is nobody wants to pay that kind of money for Citigroup. And so I think it's going to continue to get sold off until it trades in line with the relative value of the other banks, which means BB&T and Wells Fargo trade in the high 20s. I think you could see $10 decline in Citigroup. I don't know how long it'll take to happen, but these 35 strike out of the money options should be worth more, A, from seasonal weakness, or B, our thesis becoming correct. And so when you get the profits, you want to take them quicker and then leave your Bank of America, have time for the story to play out. Okay, that's it for us over here at Magnum Opus Financial, but it's a really interesting idea. It should play out. You got plenty of time to be right on Bank of America, and you should be seasonally right, at least for a trade on Citigroup. Thanks for joining us again on Lunch of the Market. Have a great day, and we'll see you tomorrow.